indicating that there was quite a bit of selling coming into the market as the market declined, and there was there was a lot of selling coming into the market as the market declined, increasing the odds that in fact there's a wave of selling coming into the market that isn't quite complete yet. Again, we have this little bit of a rally, and again we see volume pretty much stabilizing, not really going down, but not terribly heavy either to the upside. And then, of course, we have quite a bit of selling, a huge move down in the market, and at the same time, we get a very large spike in volume here. So then what do we look at? Well, we look at a period after this large downturn in the market with high volatility, lots of volume going on, but the thing that stands out are the high red day bars in which the ease of movement is quite frequent. Then we get another rally with yet declining volume again. We get a couple of days in which there's a pretty big spike there, but for the most part, volume is declining as the market is advancing. So those are the clues that we look for. Now we do get this little downturn here, but the volume was fairly light. Then we get this upturn where the volume was fairly light. Now all of a sudden we're starting to get a turn down again in the market. So let's say we've noticed this pattern that, as the market was going up, the volume was relatively flat. We get this high one-day high sell-off and high volume day, and then we start to see this pattern where the volume increases on the declines and it decreases on the advances. That is the clue that you're looking for. You're looking for those days in which volume is advancing when the market declines, and when the market advances, the volume declines. That is a key tool to determining future market direction. So we're going to play this very simply. We zoom in, we take a look at this particular period right here. We see the market starting to go up, but it seems to be falling back. We have one high volume day in which the market advances, but then all of a sudden volume starts to tail off, and we start to get some clusters of red bars here. We've got a couple bars here that are red. We've got a red here that surpassed the volume of the previous day, giving us an idea that the market is ready to resume a decline. And on this particular day, the volume wasn't spectacular, and then we get a little bit of a reversal here. But importantly, the volume increased on this day compared to the previous day. We're looking at this rounded top here as well, and we're looking for a time in which we can go short. We picked December 7th. If we go over to our Analyze tab, let's go back to December 7th. Now remember, when buying a put, we want a delta, and at least this is what I look for, between 86 and 95. So I'm going to pick this put right here, the 137s, and I'm going to go ahead and buy that. And now we're just going to advance to our current day to see how we did. Obviously, we need to put a stop loss in there. But we have about a $458 profit after a few days. And that's per contract. So obviously, the more contracts we have, the higher our profit would be. In this case, if we had a 10 contract position, we'd have a $4,600 profit in just a few days from that sell-off. Now, what happens if we're wrong? Let's say the market does not go as anticipated. I like to see, of course, I like to buy the deltas between 85 and 95. However, what happens when the deltas go against us? Well, the nice thing about puts and buying a single put is, number one, is the commission rate. Okay, so if you're buying a complex spread position, and I know a lot of traders like to do spreads and things like that, you have multiple commissions that you're paying. And I've heard from a number of different investor friends and people that I coach and traders. In my particular case, I'm very good friends with a retired CBOE floor trader. And he says, commissions end up eating into a lot of people's trading accounts. Even when they're right or when they're wrong, they put on these complex spread positions. It's very hard for them to understand the complexities of the positions they put on, number one. But number two is they're paying so much in commissions both to get into and get out of the positions, which wouldn't be so bad if they were on the winning side most of the time. But unfortunately, they're on the losing side most of the time. And so they end up not only losing equity in their account, but they also lose from the commissions that they have to pay to exit those positions. So it's very important to think not only in terms of being right on the direction of the market, but also being right as far as the positions that you take and trying to keep them as simple as possible. With a single put position, you are controlling, remember, 100 shares of the SPY. Now, at the current price of the SPY at 121.73, controlling 100 shares is equal to a $12,173 short position on the SPYs.